Hi guys, it's Arab the Plug and welcome back to the channel. In this video, we're talking about crypto tokenomics. You might have heard the term tokenomics thrown around, but what does it actually mean? How do things like supply, demand, inflation and burning affect the value of a cryptocurrency coin? By the end of this video, you will have a solid understanding of crypto tokenomics and how it affects cryptocurrency and the economic world. So let's get started. What is crypto tokenomics? Crypto tokenomics is a short word for crypto token economics or token economics. So the word tokenomics is like coined in together, token and economics. So it means the economic model that governs a particular cryptocurrency or token. It is essentially the supply and the demand mechanism that influence the value of a particular cryptocurrency and its functionality within the cryptocurrency ecosystem. In the world of traditional finance, we have things like stocks, bonds, or even fiat currency that follow a particular economic rules and regulations. So, in cryptocurrency also have a particular rule and regulation followed by each coin or token in the cryptocurrency ecosystem. Things like how a coin is distributed, how a coin is created, how it is being marketed, how it is being bought, the blockchain behind it, whether it is a proof of work or proof of stake coin. And all these things are combined together to understand the economy of a particular coin or token, which is essentially the tokenomics of a particular crypto project. Now let's talk about one of the most important aspects of tokenomics, which is supply. So when we talk about supply, we generally break it down into three main categories. The first one is circulating supply. Circulating supply simply means the amount of coins or tokens actively available in a particular crypto project at a particular time. Thinking of like how much Bitcoin or Ethereum is being traded on a particular exchange. So when you look at Bitcoin or Ethereum, for example, you see that there is always a circulating supply, which means how much of this Bitcoin or Ethereum is currently being traded on different exchanges all across the world. The second one is total supply. Total supply includes both circulating supply or circulating tokens and tokens that are locked up or reserved but still exist within that ecosystem. So total supply is more like, okay, what are the supply that are total in the market, whether they are actively engaging in the market or they are preserved or locked up, because there are some companies and countries that have some tokens or coins, but they lock them up somewhere without interacting with them, sending them, buying them within the exchanges for a very long time. So these coins are also part of the total supply of a coin. Then we have the maximum supply. The maximum supply is the total number of tokens that will ever exist. For example, Bitcoin has a maximum supply of 21 million coins. So out of 21 million coins, over 19 million of it is already in circulation. And what this means is that of all the Bitcoin in the world that will be mined, there will be no more than 21 million coins that will be ever created in this world. So a limited coin, a coin that has a limited supply like Bitcoin, is considered deflationary because as demand increases, the supply remains capped. So which means that, okay, we have 21 million coins for Bitcoin that will ever be in circulation. So as the demand of Bitcoin increases, the price is likely going to increase. And over time, we get to a stage whereby once all the 21 million are already mined and in circulation, it should be more difficult financially to be able to buy Bitcoin because it will get scarce. There will be no Bitcoin that will be mined again, and people will have to like fight for the ones we have already in the market. So that's why Bitcoin is a high value coin when you look at its potential in the next few years and decades. Now let's look at token distribution. How tokens are allocated when a particular project is launched is crucial to understanding its tokenomics. Distribution impacts how centralized or decentralized a project is and can even affect its long-term success. There are some things you have to consider when it comes to token distribution. The first one is the team allocation. How many of these tokens in this particular project are allocated for the team? As much as it is reasonable to allocate a lot of tokens for the team, but it can also be risky if the majority of the coins or tokens is allocated for the team. Also, public scale. Public scale is more like the portion of the token being sold to the public when the developers and the owners of the tokens have already taken a part of the token. Also, staking reward. Some tokens are reserved for staking reward. So when you stake them on exchanges, you tend to get a reward of that token. And also some people get some of the token when they do the airdrop of that token. So the airdrop serves as reward for people that maybe share the project or share the token, or maybe refer people to invest in the token. The third part of crypto tokenomics is inflationary and deflationary tokens. So let's talk about this particular concept. One of the most critical factors in crypto tokenomics is whether a token is inflationary or deflationary. What are inflationary tokens? Inflationary tokens are tokens that have no maximum supply, which means new tokens can continually be added over time. This can actually lead to inflation because in a case where the value of each individual token decreases, and if there is no matching supply to increase it, there will be a problem with that particular project. So which means that if a token does not have a maximum supply, for example, and a new token can always be created anytime in the years, there will actually be a problem with that token, because if there is not enough demand to match the new coins being created, then there will be a problem of inflation with that token. Deflationary tokens. Deflationary tokens are tokens that have a fixed supply, which means once the supply max is reached, there are no new tokens that will be created for that particular project any longer. For example, Bitcoin that I talk about. So once Bitcoin reach the max supply, there will be no more Bitcoin that will be mined, and everybody will have to fight or struggle for the Bitcoin that is already available in the blockchain. Deflationary tokens mostly have long-term potentials, do not actually create inflation, and in most cases they are scarce, giving them the opportunity of growth over time. The fifth thing we have to talk about is the utility of the token. We mean, what is the token actually used for within the cryptocurrency ecosystem? The utility of the token can give it a real value beyond just being a speculative asset in the cryptocurrency market. And when we look at the cryptocurrency market, we have cryptos with different kinds of utility. We have governance tokens, payment tokens like Bitcoin, we have staking tokens, we have real world asset tokens, we have gaming tokens, and we have meme coins and different categories of tokens. So you have to be able to understand that some majority of the coins in the cryptocurrency market have the value they add to the cryptocurrency ecosystem, and also the value they have to the finance world. We have AI tokens as well. The value these tokens add, it gives them a more strong economy, boosting its tokenomics in the cryptocurrency industry. Tokenomics play a very crucial role in the economy on determining the success of a particular cryptocurrency. And by understanding supply, demand, maximum supply, and all those important concepts, you'll be able to make a more informed decision when you are evaluating crypto projects and when you are investing in them. I hope you found value in this video. If you got some value in this video, ensure you hit the subscribe button, smash that like button, and I'll see you in the next one.